G'day everyone, welcome back to Pete's Investing. We review our weekly progress of a sample of blue chip stocks across Australia, the US and Europe. In this week's summary, we focus on a clean chart being CBA and also Telefonica, which is in decline but slowly recovering. If you want me to review its share price, put in the comments and I'll cover it in a future video. But as always, click on the subscribe button, the notification bell, and like the video to support the channel. But first, let's review the playlists. That's where we keep our blue chip shares every week. We update them. We also review indices every week, and that's where we keep our strategies. And in the strategies, that's where we monitor, where we document our simple trading strategy, the average down process, and some money management ideas. And also don't forget, this is not financial advice we're offering. It's simply an educational video series for your to better invest in your future. A couple of things to consider. We track on a daily chart. We track and backtest for revenue over drawdown, and I'll explain what that means in the next table. Brokerage is included in our backtesting, and we backtest and transact at $2,000 lots per trade. So let me get stuck straight into the table of results. You can see here, in this theoretical portfolio, we're tracking 6 shares across US, Europe, and Australia. And today we're going to be talking about CBA, just go through the strategy, but also talk about Telefonica and why that's in the red and how that is performing. Again, we're trading $2,000 lots. This is what's happened since 2007. We've generated $21,000 and $21,682. And per month, that's calculated on average about $124 worth over 175 months. The drawdown is basically what from the highest high of the profitability down to the lowest low of the profitability chart. And I'll explain what that looks like in the chart in a minute. And also, very importantly, these companies attract dividend yields, and it shows the ex-dividend date for these each respectively moving forward. So let's get stuck straight into the Commonwealth Bank chart, and this goes back to 2007. Now, I've deliberately put 2007 in there as a starting point to show the impact of what it did during the GFC, but also it shows the impact during COVID of those two periods. You can see here no transactions or no entries were made in 2007 on a daily chart, but it entered halfway down during the GFC period. So the drawdown is basically from that high there to that low there. That's the profitability chart. So if $100,000 is our baseline, we've generated for the since 2007 we've generated 2,482, which is at that point there, and that's represented by our table 2492. The drawdown 1,054 is simply the highest point from there down to there. It's dropped $1,054 or 1,054 from that high to that low, and then it's recovered. Now, in terms of our strategy, the way it works is, let's look at this point here. We enter when the CCI 5 on the moving average 14 of the CCI 5 breaks above zero, which it did there. It appreciated and it closed out, and we need to make at least a profit where the high-low range is at least been met. It's in profitable range, and the CCI then breaks below zero, which it did there. That's where it's closed out. So it closed out at a profit there of 2,257 and an opening revenue of 1,821. So it made about $400 or $500. As you can see here, the previous week's trade of CBA, it did quite nicely, but then it dropped off the last couple of days of trade. And you can see there the CCI is dropping off, but we're going to stick to our strategy. As long as that's in a positive and the CCI drops below, then we close it out. Otherwise, we keep it open. Next, we'll briefly show the Telefonica and how that's performed. So again, over since 2007, you can see there it opened up the start of 2007 and closed out at our profit there because the CCI would have broken below zero. It missed out on that gain. That's okay. We're going to stick to our strategy. Then it opened up halfway down during the GFC when the prices started to plummet. It opened up a position there. It rode out that wave and it closed out at the position there. So we've been open there for about a year from early 2008 and closed out late 2009. So that was a single trade, no averaging down. It was an average down where it entered back here. price plummeted during 2011, 2012, entered another position there, went sideways for a moment, then it recovered and it closed out those positions at that point there. So again, if you look at the profitability, profitability was 1,200 and it started off back here at 700. So I made about $600-700 in profits, or revenue, I should say, at that point. Now, since May 2015, it opened up one position, dropped down, ended up at second position, third, fourth, fifth, sixth, and seventh, 7 positions there. You can see there profitability, a revenue drop below. Our drawdown was quite heavy there, but it's making a recovery. So if the price still keeps recovering and it goes into a profitable stage, now it needs to break above $1,200 to break even, then we'll look at closing out. So again, that's just a quick summary of our blue chip shares, and I won't go through all the charts. But very simply, that's what they've each produced, and that's why Telefonica is in the red, but it's recovering. The others have all produced over the period since 2007, 21,682. And that's the, very importantly, we look at the profitability over the drawdown, which is 21,000 over 11,000. That's 189%. So when we do our back testing, we want to make sure that's a pretty high percentage of profitability over the drawdown. So again, $124 on average per month revenue if we traded $2,000 lots. Again, as always, please remember to hit the subscribe button, the notification bell, and like the video to support the channel. Thanks, and see you in next week's video.